fashionably late. So, welcome everyone. We're talking about PSI today. So, one of those classic sort of SME type questions that as SME advisors, I'm sure you guys would have dealt with more than once over the sort of journey of your career. And interestingly enough, PSI has been around for forever, really. We've had general rules under Part 4A that dealt with the doctors' cases. Hey, Debbie, you're right. Doctors' cases, the Gullen, Watson and Pincus, Tuppercoff, the insurance agent, all these sort of famous cases that you may have come across at uni sometime through the 70s and 80s that all dealt with professionals typically trying to divert the income that they derive to places other than themselves. Primarily to pay lower rates of tax, but sometimes for other reasons. So Part 4A dealt with PSI for, from 1936 onwards, and the former Section 260. In 2000, it was realised by the government and through the tax office that relying on the general anti-avoidance rules on their own was too difficult. It required the tax office to do too much work. Part 4A is a determination made by the commissioner that someone is doing something for the dominant purpose of getting a tax benefit. And that's a process. They have to A, identify you, B, then determine what the scheme is that you've entered into, C, then determine that the reason you've entered into the scheme, or the dominant reason, is to generate a tax benefit. And then they have to document all that. These days, certainly in the last 10 years or so, they have to take that to a Part 4A panel, which are 5 tax people and 5 non-tax office people, who then determine whether the tax office should proceed. That's not necessarily a process you want to take on with a contractor who happens to work, for Woodside and Chevron through a family company. That's quite a cumbersome process. So in 2000, they introduced the statutory PSI rules. So they're the ones we typically focus on. Is an entity a personal service business or not, a PSB? Do we have to attribute the income of that personal services entity down to the individual who performed the services? So what we're going to go through today is all of those, or are all those points there, but we're going to focus primarily on that second point, which is that determination of the income being PSI. The first question is always, are we dealing with an employee or a contractor? If they're an employee, let's not worry about the income. It's clearly going to be PSI, salary and wages. We can't divert it or split it. If they're a contractor, then we look at the nature of the income. And there are 4 types of income. We'll spend a bit of time on that, because that, I think, is the key to determining whether PSI statutory or general rules apply. And the reason you don't want them to apply is because the PSI rules are all about stopping you alienating income. And alienation just means splitting it to entities that didn't derive it, so spouses, adult children, or corporate beneficiaries, or retaining it in an entity that didn't derive it, i.e. a family company that a contractor works through. The contractor provided the services, the company derives the income, but pays tax at 27.5%. That's much more attractive than taking it through to the individual at 47%. So retaining it in a company or splitting it are both considered alienation. And that's what we'll look at. If we're deriving PSI, what can we do with it? We'll look at that concept of PSB, a personal service business. A personal service business takes you out of the statutory rules, but puts you in the general rules. So we've still got 2 sets of rules. So we'll talk about that. If it's not a PSB, what happens? Now, thankfully, only a very small percentage of entities that derive PSI are not PSBs. They're the ones who really get whacked. So we'll talk briefly about that, because hopefully that's not too many of your clients. And those first 5 dot points are really the PSI discussion that we'll go through. But I want to finish it off with a discussion on these ATO risk guidelines for professional service practices. It's got nothing to do with PSI directly. It's the tax office 4 years ago publishing guidelines to try and, I suppose, control how professional service businesses, so like MKT and like your firms or other big accounting, law, engineering firms, how they deal with their income. So even though they've accepted that they're not deriving PSI because they're businesses, they still want to put some guidelines on where that income is taxed. So we'll talk about where that's at, because it's sort of a pseudo PSI rule that they're trying to apply to professional service practices. All right, so that first question, are we a contractor or an employee? So the importance of that is if you're an employee, then anything you receive from the client / employer is going to be salary and wages. It's going to be accessible to that employee. There are plenty of guidelines, there are plenty of case laws, not necessarily all tax related as to whether someone's a contractor or an employee. And there are some really good online tools the tax office has that will determine whether someone is a contractor or employee, at least in most cases. The key thing to look out for, and probably the easiest way to get through this question, is to determine, well, what's the entity that's providing the services? Because only an individual can be an employee. You cannot employ a company or a trust, which is why some of your clients who may contract to bigger firms are told when they tender for a job, we only give contracts to entities such as companies or trusts. You need to have a PTY or a trust. We will not engage you as a contractor if you're an individual. The reason they do that is because they don't want to have to go through those tools and determine whether that contractor is actually an employee, and therefore on top of the contract they're paying them, they've got to pay super guarantee, they may have leave entitlements, other entitlements that employees get. So it works both ways. It's typically easier if you've got a client who is contracting. It'd be easier if they set up an entity, and then the employee question is off the table. And if you've got a client who engages contractors, then you clearly want to force them to set up as companies or trusts. So then you pay them an amount plus GST. That's the end of the story from a tax point of view. Payroll tax, interestingly, will look through an entity, so they'd still be considered part of the payroll tax group. But from an income tax, super guarantee, they're not considered. So are they a company or trust? If they are, great. Not an employee, we can move through that one. So they are an entity. Let's deal with an entity. That's typically what contractors will set up. It's pretty cheap to set up a trust or even a company these days. So we then need to look at the income that entity is deriving and determine whether it is PSI. I said before there are 4 types of income. You go through each of those. If it's PSI, then this is what you're faced with. You're not faced with this with the other 3 types of income. And if there's one thing you take away from this session today, hopefully it's this slide, because this is the slide, or at least the concept, that many accountants fall foul of. There are 2 sets of PSI rules in the PSI regime. So I've called it a regime because it deals with more than one set of rules. There are the statutory rules that were introduced in 2000. They're the ones that deal with the results test, the 80% test, the unrelated clients test. We'll go through that later. They deal with attribution. They limit how many deductions you can claim, or the types of deductions you can claim against that income. They're the nasty ones. They're the ones that require self-assessment by us, the accountants. We need to determine whether the statutory rules apply, and if they do, regardless of where the income is, if it's in a trust or in a company or been distributed out to family members, we need to gather it all up and attribute it into the individual's personal tax return. So they're nasty, exactly as the government and the tax office wanted them to be. Their application is nasty. But just because you get out of the statutory rules, and as we'll explain, for most contractors it's actually not that difficult, just because you get out of the statutory rules, i.e. you've got a personal services business, a PSB, then you're still caught by the general rules. And the general rules are administered through Part 4A. And the reason most people get confused about that is because it doesn't say in black and white you cannot alienate personal services income. The general rules say that you cannot enter into a scheme where the dominant purpose is to generate a tax benefit. The case law and the rulings from the 80s and the 90s all say that alienating personal services income is a tax benefit. And the tax office will apply Part 4A. So, big one out of that is just remember, just because your client's a PSB doesn't mean they can then go and split or retain that income. They're still subject to those general rules. We'll go through both on the way through. So I start with a flowchart that is sort of helpful, but also leads to a number of questions that I end up having to field. And this flowchart was developed by someone in Parliament, or in the sort of Office of Parliamentary Counsel that draft legislation in the 90s, the late 90s. So when they introduced the statutory rules, the Treasurer's press release at the time had that PowerPoint in it. And that PowerPoint has lived on forever through tax office fact sheets. It's even in one of the rulings, TR 2001-7, which we'll talk about, deals with what is PSI. And that seems to be the main explanation from the tax office as to how the PSI rules apply. And you'll see the top box is the question, does an individual or an entity, we're dealing with entities, have income that is mainly a reward for personal efforts or skills of an individual and not mainly a reward from the use of assets, the sale of goods, or a business structure? So the first question to look at is classify the income. And that's the 4 types of income. Is it mainly a reward for personal efforts or skills of an individual? That's PSI. Is it mainly a reward from the use of assets, the sale of goods, or income from a business structure? That's where we're going to spend a fair bit of time, because that's the most important question. Because if you answer no, i.e. it's one of the other 3 types, not PSI, then the statutory rules don't apply. They don't say it, but again, this is just, someone's flowchart. It should also say Part 4A will not apply either, because it's not PSI. So if it's not PSI, it's not in the regime. So neither statutory nor general rules can apply. If you answer yes, then you start through the statutory rules. And the other great point, hopefully you'll take away from today, is whenever you see a flowchart dealing with a provision of the Tax Act, the key thing is to get out of that flowchart as quick as you can. Because the longer you're in it, the worse it's going to be. So, okay, if we're out of it here, you beauty, that's great. But if we're in it because we've got PSI, then we want to get out at the first alternative, which is the yes box here. The individual or the entity is conducting a personal service business. So we've got a PSB. And if we don't get out there, then we've got further opportunities to get out here. So if we're conducting a PSB, the statutory rules don't apply. Division 85 and 86 do not apply. However, Part 4A of the Income Tax Act 36 may still apply if income splitting occurs. Now that's good and bad, because some people would read that to say, well, Part 4A may not apply, because it says may still apply. And it also says if income splitting occurs. But if I retain the income at 27.5 cents, that's not income splitting. I'll just keep it there until I need it, and then I'll pull it out later. But alienation is what it should say. It should say, however, part 4A will apply if alienation occurs. But it doesn't. Just because someone in the Office of Parliamentary Counsel 20 odd years ago just decided to keep it simple. There are fact sheets and rulings that go behind that, but who looks at that stuff? Only people like that. So we'll take you through all that kind of detail. Obviously, if you stay in this thing all the way through, that's the nasty bit. The statutory rules apply, it limits your deductions, and it attributes the income, obviously, against that individual's personal taxes. So let's dig into those 4 types of income. The first one, is it mainly from the supply or sale of goods? We'll talk about the word mainly a little bit later on, but that is important. It includes services that are incidental to the supply. So it's fairly easy in a lot of the cases to see if someone's selling things, even though they're standing behind the counter and selling them, then the income is mainly from the supply or sale of goods. It's not PSI. It also includes where services are incidental to that supply. So if I engage Craig on the weekend, had a lot of time on his hands, so he installs fences. So I want to put a fence up. So I get a quote from Craig to install the fence, to supply and install the fence. So the installation would be personal services, but it's incidental to the supply of the fence. And mainly means more than 50%. So as long as the invoice that he gives me for supply and installation of the fence, if more than 50% of it is in relation to the supply of the fence, it's all mainly from the supply or sale of the fence. It's not PSI. So you always look at that. It can still involve a level of personal services, and selling something does. Someone actually has to take the money and hand over the goods, but that's incidental to the supply or sale of the goods. So you don't break up each bit of it. We'll talk later on, unless they are separately identifiable obligations. But if they're incidental to it, you lump them together. And what's the main, the main part of the transaction? The supply of goods. It's not PSI. Is it mainly for the use of an asset? So I want to put a pool in. So I need a hole dug in the back of my yard. I need a bobcat guy and a truck. So clearly someone's going to be driving the truck and the bobcat, but more than half of my invoice will be for the use of the bobcat and the truck. So there's clearly personal services involved there, but it's incidental to putting that asset to work. So I'm mainly paying for the use of that asset. It's not PSI. The third one, and we'll spend a bit more time on this later, is the income mainly from a business structure? Because the kind of businesses we're in and other professionals are in is generally providing personal services. But when we look at whether the income is PSI, we're not looking at the services of every individual. We're only looking at the services of the principal or principals. So the owners, the directors, or the partners. So a business structure deals with individuals, employees, and assets other than the principals. So an accounting firm, like my accounting firm, there are more employees than principals. There's goodwill in relation to the name, there's assets and odds and sods. So that would be accepted as a business structure that's generating the income. The employees, the assets are generating more than half of the income, not the principals. Therefore, that's not PSI. So if you answer yes to any one of those three, it's not PSI, which means you can alienate it. Subject to those guidelines for professional services businesses we'll talk about later, but that can be split, that can be retained. You can pay lower rates of tax. So the first thing you look at is the income. And you can actually break it up into essentially invoice by invoice. It may be that the plumber who comes around to fix your leaky tap supplies a new washer. and the invoice says, you know, labour, washer. Now clearly they're integral. But they've also got a special on new flick mixers. And you don't need one installed right now, but it'd be a good spare. So you buy a flick mixer. So the invoice has, you know, fixing the leaky tap, installing the washer, and buying a new flick mixer. You can separate that. You could say, clearly the fixing the leaky tap, installing the washer is mainly for the personal efforts or skills of the plumber, assuming it's a one man, one woman plumber, sole practitioner, that's PSI. But any profit they make on the flick mixer, that's from the sale or supply of goods. So you can drill it down to that, provided the evidence is there to show it. And it's not artificial. We'll talk a little bit more about that later. So that classification of the income is really where we should be spending our time. Most accountants get fixated on, is it a PSV or not, and what's the implications there, what can I do? We'll talk about that, but can you classify the items of income that the entity derives to determine that some of it is not PSI? And that's really where I want to take you. And that ruling 2001-7, which deals with what is PSI, is a really good ruling because it had lots of examples and lots of, I suppose, factors that need to be considered when you classify income. And a lot of it is, can you classify it as being, from a professional point of view, income from a business structure or personal services income of the principals? And that's the one that looks at a distinction between number of arm's length employees, presence of goodwill, income producing assets, other things that generate the income of the business other than the principal. So the meaning of PSI is relatively simple. Again, mainly, so we're not looking at solely, mainly a reward for the personal efforts or skills of an individual. That individual is the principal, not all the people that are generating the income. The simple examples that are actually listed in the EM and some that find their way even into the division that defines Section 84 that defines PSI, income of a professional person practicing without professional assistance. So when they talk about employees, they don't mean administrative employees. They mean professional employees. So employees who are actually charging fees. If you don't have employees, then the income is going to be PSI unless, in the plumber example, we've actually got some goods we're selling that are separate from the supply of services. And there's another older IT that deals with sort of narrowing down what that actually means. Three key elements of that particular definition. The first one is identifying that individual. I said it's the principal or principals. So we identify who the principals are. They're the ones we need to determine whether the income that's been derived is mainly, more than 50%, a reward for their personal efforts or skills. The second element, you look through an entity. So just because those three principals are engaged by a company and the company issues the invoices, let's look through that to those three individuals. Who generated the income? And thirdly, again, was it a reward for their personal effort or skill? So you're tracking the income through to the principals and what they've actually done. Two parts of that. The first one, relatively simple, but there was some sort of argument in the 90s when the tax office started to get a little bit more active on professionals alienating their income. Remember, this is before the statutory rules. There was an argument that a contract for services, so a contractor generally contracts to do something, whereas an employee will have a contract of service. So, 8 to 5, X days a week, that sort of stuff. There was an argument that a contract for service was an asset of the entity. And the income that was derived from that asset. So it was income from the use of an asset, not income from personal efforts or skills. After the 90s, and the statutory rules included a definition that applies more broadly, any contract that involves services is going to be PSI if the income received is mainly a reward for those services, regardless of the fact there's a contract for those services or otherwise. So personal efforts or skills, fairly easy to see. If you're using your hands or your mind to do something, then that's likely to be personal efforts or skills. And again, it's, skills is more professional trade people. Personal efforts would be just digging a hole, that doesn't necessarily take any great skill, but it's still personal services. So it's that, from a hole digger labourer to a cardiovascular surgeon. They're all in that personal efforts or skills spectrum. The more important one to look at there is mainly. So I said mainly is more than 50%. So if you look at a particular invoice from a client, a contractor, and the invoice, whether it's mixed or in one line item, if it's mainly a reward for the personal efforts or skills of the principal, it's going to be PSI. There's no argument about it. But in the tax ruling, 2001-7, it does allow you to identify and isolate different portions of income. So if there is commercial substance between apportioning the services that are being provided, and some of those services or goods are not from the personal efforts or skills of the principal, then they can be separated as not being PSI. So the example of the plumber and the flick mixer, that's one. Another one that we dealt with recently, so engineer, worked for a company, contracted to a number of different companies, civil engineer. Occasionally, he had access to his own drafts people. So occasionally within the contract, if the client wanted it, he would handle the engineering designs and also the drafting. Now he would contract that out to others. Most of the time, he just did the engineering and the client would have their own drafts people to do it. In the contract, and he wasn't doing this, but we've got him to do this, he was actually making a fair markup on the drafting services. So of the $400,000, hang on, of the $400,000 that he actually derived in that entity for the year, about 100,000 of that was from drafting services, and he was only paying his contract drafts people about 30,000. So there was sort of a gross margin there of 70. So he wanted to argue that that was not PSI because that didn't arise from his personal services. But the way he was invoicing and the way his contracts were drafted, it was all lumped together. So if you looked at it lumped together, then more than half of the bills he were issuing were hid. So it was PSI. So what we've got him to do is, for new contracts, he is isolating the services he's providing. And the invoices, he is isolating the fees for those particular services. And the accountant is also now going to split up the P&L so it has engineering services and drafting services. So we can clearly see what he's making from drafting. We can apply the direct costs against that, and we can also apportion some of the variables against that. So of those numbers we talked about, of the 70,000 sort of gross margin, there's just a bit under 60,000 that we've been able to isolate as not being PSI. That's income from the drafts people that he engages. It's not incidental to his services. Most of the time, he just does the engineering and they engage their own drafts people, the client. But he just has this relationship where sometimes he can do that under his contract. So you can apportion the income. So if you've got clients that do use other subbies in a sense, well, have a look at what they're doing. Are they incidental? Do you need to group them together, or are they separate? The engineer doesn't do much at all in relation to the drafting, other than give it a quick once over because it's coming out under his contract. He doesn't have the technical skills to add any real value to it.
So you would suggest to portion the variables in that situation?
Yeah, I think that's fair. So the variables that do relate to the entire business, it should be, and we've just split it income-wise, 1/4
So you
of
could
the
say
income.
all those variables would be there just for the engineering anyway, so the drafts on top, there's no additional variables, so...
Well, I just think it's like any variable, you should, if they're fixed, you can allocate them, but if they're variable, they should go across both sort of sides of the income. There's no hard and fast rule on that, but I just think being reasonable, if you went to an argument with the tax office, you basically lay that out. It's 300,000 engineering services, here's the direct costs against that, and here's the variables that we've apportioned 3/4 and 1/4. There's 100,000 of drafting, here's the direct, here's 1/4 of the variables. I don't think we'd have a problem with the tax office. So you can use that mainly argument, you can use that commercial substance argument to basically look at separating the income that's being derived. As I said, it's got to have some commercial substance to it. So the plumber and the washer, we can't allocate 55% of the bill to the washer and 45% to the plumber. So you can't artificially create that separation to either have it mainly for the sale of goods rather than personal efforts, and you can't separate things that are incidental. So it talks about a tradesperson and their tools. So you couldn't have, the painter who then charges separately for the paintbrush and the tray and the ladder and all that kind of stuff and break that into their invoice. That would not be, commercially sort of what was done. So it's got to have a commercial basis behind that separation. The ruling then goes on to I suppose, put some fairly simple rules in terms of that, what can't be apportioned. So we spoke about the tools, drawing board of a draftsperson, nails and glue by a carpenter, wiring by an electrician. So you can't get cute on that level and break all that up and then put markups on those particular supplies or assets. It does say it's an exercise of practical judgment. So again, Nathan, that's sort of what we were doing. Okay, we've isolated them. The practical judgment is then, well, those variables should be spread across it. There's no hard and fast rule. The good thing about that means there's no right or wrong answer necessarily. You just got to have a reasonable basis behind it. So that's what we'd look at doing. What we're doing for the engineer, again, if you can allocate those proportions in the contract, in a sense, the engineering services, drafting services in that example, well, again, that's going to be difficult for the tax office to get behind because all the evidence we've got clearly shows that separation. And unless you shouldn't separate those two and no one ever separates them, and the tax office, might be able to get an expert that says that, well, outside of that, I think we'd be fine. We've taken, the right steps. We've undertaken that sort of practical judgment and determined what the PSI.
So he's showing them at a market rate those drafting services.
Yeah, he's charging at 100, and that's actually what he does charge for them. But he's only paying these blokes 30 to do it.
Can the ATO argue that it's not arm's length market?
Well, they could do, but these guys are arm's length. He was slightly embarrassed when all those numbers are out a bit, but it is what it is. Especially from the client's point of view, they need to find these guys direct so they can get the work done at 30, not 100.
Yeah, exactly.
Yeah, when they look at it, they know, oh, we're paying 100 for that. Wouldn't they know that it's out there for 30? Is he actually showing them?
Yeah, he's going to show them that. Now, he's a little worried about that, but the alternative is, well, okay, it's all going to be PSI then.
Mm.
So, yeah, that if the client goes to that extent of then separately quoting each level, it might come back to bite him.
Yeah.
But, maybe you can't have it both ways. If it's not, immediately apparent that it's PSI, and you perhaps don't want to then have to go through that apportionment process, then the third type of income that we went through before is the income from a business structure. And that's where most contractors, certainly contractors that have got some substance behind them, would want to find themselves. And that, as I said, it doesn't look at what the business is doing, i.e. the business can be providing services, but is there a structure around that business that provides the services? And primarily, they're looking at assets or employees. Assets and or employees. So, the activities, obviously, if it's more slanted to services, then you'll need to work a bit harder on some of the other factors. If there are, the provision of assets or the use of assets in that business, then it's more likely that it's going to be a business structure. The more it relies on a principal's skill and judgment, then the more likely it's going to be personal service income. If there are non-principals who are using skill and judgment, employees in professional practices, then it's leaning towards a business structure. And again, the use of income producing assets. So what level or investment in assets is used to generate the income? The more the use of assets, the more likely it is that it's a business structure. It's not a PSI deriving entity. The key one though, and the easiest one, because unlike what the tax office do now, back in the 90s, Debbie and I used to work there and it was good fun, they used to actually do meaningful rulings. So they, in 1991, issued 2639 and it gave a rule of thumb. And the rule of thumb said, we will accept that income is from a business structure if the practice has at least as many non-principal practitioners as principal practitioners. A practitioner is an employee who derives income. So a fee earner, not an administrative person, a fee earner, so all of us. A principal is an owner, so a director or a partner or a shareholder. A non-principal is obviously a non-owner. So the rule of thumb says, as long as you've got one principal and one non-principal employee, then they will accept, whatever you're doing, that it's income from a business structure. Now, that is not mentioned really anywhere else other than that, almost 30-year-old ruling, and not something that they tend to throw out there that often. I actually think it is particularly conservative, which I don't say about a lot of things the tax office do. We would tend to want to run an argument that there should be at least one more than the sort of even number. So there should be 2 employees for one principal. Because I'd be arguing if it's mainly from a business structure, that means more than half of the income is from the employees, not the principal. But the tax office have just said 1 and 1. So you could run with that. As I say, I'd rather have 2 employees for every principal to be safe. The other way you could look at it is the fees generated. So maybe the employee generates more than half of the fees. Mainly a reward for the personal efforts or skills of the principal? No, because more than half the fees come from the employee. Obviously, the more the employees, the more likely it is that that number will actually be over half. So if your contractor is at that level, certainly has employees that are charging, then hopefully, either through the rule of thumb or otherwise, you can determine that that income is not PSI. It's income from a business structure, which means we're out. We're here. The statutory rules don't apply. the general rules don't apply. So all of that discussion, for a fair bit of time, is really just about that first box. That's all that is, classifying the income. If it's none of it's PSI, great, we're out. If some of it's PSI, can we determine bits of it that aren't? And then the PSI rules will only apply to what's left. So that's that apportionment or allocation. So don't just, most accountants will walk straight through that first box and worry about results tests and 80% tests. We think you should spend more time in that top box. Let's classify that income.
Sean, sorry, just got a quick one. If you've got two principals working on same project, every project they bought 250.
Yep.
So would you say that it's not?
Well, they're two principals. So each principal
or separate
is PSI.
PSI, yeah.
So they would need to have, under the rule of thumb, one employee each.
Yeah.
Or I would be safer if there were 3 employees and 2 principals.
Sorry, coming back to that first, mainly 50% or more.
Yeah.
So even though it's just 50% each, you get to separate.
Well, you actually
each
remember
one.
that as the first element is identify the principal and their income.
Yeah.
So we're dealing with 100% of principal 1's income and 100% of principal 2's income.
Yeah.
We're not putting them together because they're principals.
Yeah.
So, in our practice, we've got 3 principals. So essentially, you divide the fees in 3. So we would need to have, by rule of thumb, at least 3 employees. 4 employees, would we say. So you don't lump the principals together, you actually separate them. And you run it through that way. What happens if it is PSI? So some of it's going to be PSI. In that example, it's going to be PSI because it's just principals earning income. Those old enough to remember, there was a bloke up in the hills, accountant, that used to get all these engineers together, stick them in companies, all principals, and try and argue just what you said then. They'd all go off and do different stuff, but it would all be billed through to one company, and he would manage that. Fell over big time. He ran away somewhere. But all these guys got absolutely hammered. So bringing them all together doesn't mean you've suddenly got 5 people earning the income. It's a business structure. You've got 5 principals.
Even if they're working on the same project.
Doesn't matter.
Yeah.
Their principals.
Their portion would be their PSI.
You're going to sack one and make them an employee. So if it is PSI, then we're down the left-hand side. We're into the statutory rules. And as I said, we're in the flow chart. We want to get out as quick as we can now. We've got into it. Dan, how do we get out? First opportunity to get out is a results test. So we look at the income that's generated by the principals and we determine if at least 75% of that income satisfies these 3 sub-tests, then we pass the results test, which means we're out of the statutory rules, we're a PSB, we're subject to the general rules. So those 3 sub-tests are, firstly, the work is done to produce a particular result. So the only way you don't pass that is where a contract is on an hourly rate. We need a contract engineer or a contract accountant or a contract lawyer, we'll pay you X dollars an hour. There's no result there. But if you engage a contractor to prepare a set of financial accounts and a tax return, that's a result. Or to prepare a legal agreement, or to complete design drawings for this particular project, that's result-based. So a true, genuine contractor will generally be engaged to produce a result. Not that difficult. The ones that find that difficult are the ones that are just on an hourly rate. So the Woodside Chevron engineer who is just on an hourly rate. And Woodside doesn't want to have to worry about super and industrial relations laws and leave and all that kind of stuff. And so it's got to be results-based first, and the contractor provides the plant, equipment or tools to achieve the result. Doesn't matter how little those tools need to be. If it's just a laptop or a calculator and a pen, as long as whatever's required, they provide. So if the contractor comes in to prepare the accounts and the tax return, that's the result, but then they get to use all of the equipment of the firm, then they're not going to pass the results test. So that's not going to work. And the contractor's liable for the cost of remedying defective work. Now the tax office are fairly lax on that particular one. All professionals have obligations, certainly if they're contracting outside of being employees, and negligence claims could be made against most, if not all, contractors, not just professionals. So the fact they have those negligence obligations, or even more if they actually take out insurance, so PI insurance, that would be enough for the tax office to say, well, they'd only take that insurance if they're liable for the cost of remedying it. We'll accept they pass that test. So again, a genuine contractor, whether they're a trade person or a professional, would take out some kind of insurance, typically, and that would enable them to satisfy that one. So if they get yes to all three, they're a PSB. So we're out of the statutory rules. We're in, but we've got out. So we'll deal with the general rules, which we'll touch on later. If you can't get out there, so any one of those three tests you couldn't pass, your contractor entity is not caught yet. It has another ability to get out and be a PSB. And that's what I say, it is fairly easy for genuine contractors to get out of these rules, which is not what was planned 20 years ago. The 80% test says 80% or more of the PSI is from one source. So it's a bit of a negative here. You actually want to fail that test. If you pass that test, i.e. you work at Woodside, and that's your only contract, then you wouldn't get through that test. You would pass it, which means the only way you could be a PSB would be to go to the tax office and ask them for a determination, which they would very rarely give, unless perhaps in the previous year you'd worked for half a dozen clients, and next year you expect to work for half a dozen clients, but this year Woodside made you an offer that you couldn't refuse, particular project, it's going to run for 10 months, and you're going to generate more than 80% of your income. Then the tax office might accept you as a PSB in that middle year.
Is that when the income is received, or is that when the income is received?
Yes, so you'd go in that particular year, because you classify yourself as a PSB or not on an annual basis. So you can chop and change. And that will then determine what deductions you can claim and where the income goes. So in that year, you should go. If you've got more than one client, which again, most genuine contractors would have, and no one client generates 80% or more of your income, then you move through that test in a sense, but you only get to be a PSB if you can then pass one of three other tests. So it's kind of a funny test there, because it sort of relates to the unrelated client tests, but it sits out on its own. The unrelated client test says, firstly, you must derive income from two or more clients that are not associated. Now you say, didn't I just pass that test? Well, no, you didn't. The difference in this test is the two or more clients can't be associated. Strangely, with the 80% test, those two clients could be associated. So you could do 60% of your work for Wesfarmers and 40% of your work for Coles and pass or get through the 80% test. But Wesfarmers owns Coles, so you wouldn't get through the unrelated clients test. Why don't I just stick that all up in the 80% test? I don't know. I don't write this stuff. So they've got to be two unrelated clients. And you then need to be able to show that you received that work as a result of providing or making offers to the public. A direct result of making offers to the public. So that means advertising. So what they want to see is that entity, that contractor, advertising its services, and then say that job came from that advertisement, which is again probably easier said than done. Thankfully, the practical experience I've had on this is that the tax office are fairly loose in that sort of making offers or invitations to the public. So back in the day, they'd been happy if you had a yellow pages app. These days, they'd be happy if you had a website. And they don't necessarily need you to match, even though that's what that test says. They don't necessarily need you to match a website to the job. When those cases have been taken on, though, it does become a little bit more difficult. So Yalos Engineering provided engineering services in the oil and gas industry. Very small section of the public that would need the services. Not a lot of use in them taking out an ad in the local paper or the yellow pages, or even potentially having a website. It was this sort of single engineer working through a company. The tax office said that's not a large enough section of the public. You know all these people, they know you, they call you when they want a job done. You're not making offers or invitations to the public. Thankfully in this one, the tribunal looked at it a little bit more practically and said, well, the section of the public can only refer to the section of the public that would need the services. It does not need to advertise to everybody, knowing that 99% of the population don't need your services. That would make no sense. So the tribunal in that case said those 6 companies that you generally network with and contact, that's a section of the public. Cameron's case went the other way. Cameron was a drafter. So a draftsman could provide services to a much wider range section of the public than Yalos could, but he didn't. Basically had 6 guys that used to generate work for their drafting practice. Didn't go any further, didn't want any more work. Tax office said that's not a wide enough section of the public. You're really just using word of mouth and networking, and whilst word of mouth is okay, it needs to be across a section of the public. The tribunal agreed with the tax office in that one. There was a broader group that you could have made offers to, you chose not to. So we're not going to accept that you passed that test. So technically that could be difficult to pass. Practically, unless for some reason you've upset the tax office that you've found yourself in the tribunal, as long as you've got a website, which you can get pretty cheaply these days, you would generally get through that. A bona fide, a genuine contractor, you would think would be making those offers. Tendering, applying for tenders through tendering processes is certainly accepted there.
Sean?
Yeah.
Why didn't they pass the results test first, those 2?
Yeah, I don't know.
Because, actually a draftsman,
You would think so.
you would have thrown back at you if you still had a job.
Yeah. Don't know, they were dealing down the next rung. So, yeah, good question. What would they have been doing that wouldn't have been results based?
Yeah.
Both of them.
Yeah.
Yeah. It would have been, because the plant equipment, the tools and equipment would have got through. The insurance they would have got through. Yeah. It must have been something, maybe they were just getting paid on an hourly rate. That must have been it. So if you've got through the 80% test, but you couldn't get through the unrelated client test, you still have the employment test. And the employment test just said if you're a contractor operating in a trade, as long as you've engaged an apprentice for at least half the year, you pass that test, which means you're a PSB. If you're a professional or some other kind of service provider, as long as you've got an employee that makes up at least 20% by value of the work performed, so if the company is making $200,000, as long as that employee is generating 40,000 of that, you pass the employment test. It just means they're a PSB. Individuals can be associated, so they can be spouses or family members. Strangely enough, those spouses or family members couldn't contract through their own entities. That wouldn't count. So they have to actually be employed. Others could just be contracted. They don't have to actually be an employee. So you could contract out outsourcing work, say, which a number of accountants do, and that would still qualify. The last of those three subtests, if you couldn't get through unrelated clients or employment, is the business premises test. And I thought if you got to this level and you're able to satisfy this, then you'd be surprised you hadn't passed something earlier on. All four requirements must be passed. So they must maintain business premises at all times. So a place of business where they undertake those activities, not a place of business that they rent to get past the test and work from home. They must have exclusive use of the premises, so serviced officers don't work. They've actually got to have a space for their exclusive use. And the premises must be physically separate from premises used privately, so they can't be your home office or attached to your home, and they can't be the premises of a client. Now, they do make mention of things like doctors' surgeries, as long as they're completely separated from the house in terms of walls and whatever, but premises of a client are complete no, you wouldn't pass that test. So if you've got through those at any level, then you're a PSB, which means the statutory rules don't apply. You've had to do a bit of work, you've had to work your way through that flow chart, but at least you've got out. At some point you got out. And as a PSB, all we've got to worry about are the general rules of Part 4A. And I talked about them in that introduction. And there are plenty of rulings that you can see by their numbers are very old. So these are rulings from the 80s and the 90s. And they dealt with IT 25, which then became 2503. They dealt with your typical professional person or tradesperson moving their business from a sole practitioner into an entity. So IT 25, which was 1981, dealt with the incorporation of medical practices. So doctors moving their business into companies. Happens all the time now. It was starting to happen in the late 70s. The tax office needed to put a ruling out because, as clients still do today, and we're still faced with a situation where the only talk of tax rate reductions is at a company level. No one cares about us, how much tax we pay. It's all at a company level. So you can understand the attraction of moving your activities into a company and only paying tax at the corporate rate of tax. And in 1981, they didn't have Division 7A. So you could pay tax at the company rate and then loan the money out and not have any issues. So IT 25 said, we'll let you do it, but only if the only reason you do it is to make super contributions for the doctor. Because back then, the sole practitioner couldn't pay super for themselves. If you retain any income in there or split the income through dividends, we'll apply Part 4A. And then 2503 sort of extended that and also said it applies to other kinds of practices, not just medical practices. IT 2121, again, sort of mid-80s, dealt with family companies. Again, anyone just moving an activity that was generally personal services income into a family company and splitting the income through dividends or retaining it and paying a lower rate of tax. 2330 was specifically on income splitting out of trusts. So all of those rulings say, if you seek to alienate personal services income, we will apply Part 4A. And all we got was that little box, unfortunately, on the flowchart that most people actually see. And when I have meetings in this room and others with engineers who want to split their PSI, they show me that flowchart, point to that. And then I have to bring out 5 rulings, trump them on that, send them away to read that. So that's a key thing. Just because you're a PSB, just because you've got out of the statutory rules, doesn't exempt you from the principles in those rulings. They're still there. They're still live. 30, 40 years on, they are still there. There is an ATO fact sheet that is a little hard to find. That specifically ties all that in, I suppose, tax office speak. And it clearly says that the tax office would seek to apply Part 4A, where arrangements are entered into to retain income within companies or to split income either through distributions out of trusts or dividends out of companies to non-principal shareholders, or through the payment of wages, unreasonable wages, out of those entities to non-principals, so family members and the like. So it's pretty clear, but again, the amount of accountants and their clients who remain confused about how good a PSB is, it's better than the attribution, because when you attribute, you're limited in the deductions you claim, and that income is deemed in that year to have been derived by that individual. And you would all seen on the tax returns, there's a little box, attributed PSI income. You may have never filled it in, but that's what the statutory rules, if you get to the bottom of the flow chart, that's the box you fill in. That's the real bad one. So all of that income, we restrict the deductions, the net amount gets whacked in that individual's tax return, whether they received it or not, even if it's still in the company, or we paid $40,000 in legitimate salary to a spouse or a child for admin services, doesn't matter. All of that income is attributed to that individual. The benefit of a PSI, good, what was that next one? The benefit of, a PSB, rather than the attributed PSI income. Jeez, what am I doing? Haven't even had a drink. The benefit of a PSB rather than attributing the PSI is that, as I said, we're not limited in deductions. So there aren't restrictions under the statutory rules. Essentially, the individual is limited to the deductions they could get if they're an employee. If you're a PSB, whilst you can't alienate it, you can still pay reasonable wages to a family member who performs administrative tasks. So if you pay your spouse $10,000, $20,000 a year to do admin tasks, that's a deduction against the PSB's income. And the net amount has to find its way to the individual. Importantly, on top of that wage, you can also contribute up to the age-based limit for their super. So there was a case called Ryan's case, 10 years or so ago, and Ryan's case basically said that you don't aggregate the super and the wage. So in Ryan's case, paid the spouse $25,000 for admin tasks. That was accepted as being reasonable. Also contributed $50,000 to super, as it was, with the age-based limit. Tax office said they're not worth $75,000, they're not producing $75,000 worth of value for the business. You shouldn't get a deduction. The tribunal said they're only getting $25,000 for their efforts. $50,000 is because of their age. It's not deductible under 8.1. It's deductible under 82 AAS, which deals with super contributions and age-based limits. So that's a great benefit of a PSB. You can pay a spouse or a family member a reasonable wage and max their super. The other benefit, and it's a bit of a stretch from how it started. So in IT 2503, the tax office said, we understand at 30 June you won't know exactly the income that the company's derived. So as long as you make a reasonable effort to pay all the income out by 30 June to that principal, then you can pay the balance out, as a dividend next year. Now they clearly meant, you'd probably get it 90% right, and you pay the 10% out. We've probably pushed that a bit, and I think knowing that the tax office's only fallback is Part 4A, which is a lengthy process for them, we think as long as you pay out 60, 70% of the income, you might get at least 1 year's deferral. You then pay out the balance, 30, 40%. Still got to go to that individual, but you might get a timing benefit. Now, is a timing benefit a tax benefit under Part 4A? Yes, it is. Would the tax office apply Part 4A on a timing benefit? They might, but I think it's well down the risk scale. They don't have enough resources to apply Part 4A to blatant breaches of this, let alone, someone who's tinkering around the edge.
So you can't pay 70 and then 30 as a dividend.
You can pay 30 as a dividend, but it's got to end up with the principal.
Yeah, so it can't go
You
across
can't
the-
split it, no, because then you clearly have alienated it. So the only benefit's the timing benefit.
So how do you, so it's not attributed PSI, how do you get it out as a wage or?
A wage or a dividend. Typically you want to do it as a wage or a trust distribution, because if it's as a dividend or a trust distribution, if you did it as a wage, then you got super.
So if you've done your trust resolution and it says, oh, all to Y, but technically it can't go there.
Yeah.
How do you do that?
How do you undo it?
Well, yeah, well, what do you do? So do you follow the trust distribution or do you?
Well, sometimes you want it to be attributed PSI, because attributed PSI deems it to be there anyway.
Yeah.
But if it's not, if it's a PSB, then what you've done there is essentially create a tax benefit. So if the tax office found it, they would amend the wife's return, take the income out, amend the husband's return and include it. Interestingly, I'm not sure that you can do that yourself because you've got a trust resolution that said all of it goes to the wife. What could you do? I mean, she can't pay him a wage.
Ordinarily, yeah, we do the attribution, but it sounds like if it's a PSB, you shouldn't do that.
No.
So that's what we need.
Yeah, and that's the problem. It's easier sometimes if you are happy for it to all go there, for it to be attributed, because you don't have to pay a wage, because you don't have to worry about super. A lot of people don't want to pay for their own businesses that extra 9 and a bit % super. But if it is a PSB, there's no attribution. You're then required under Part 4A not to alienate it. Once you've alienated it, that's a good question. I don't know how
You just word your resolution that any PSI income.
I've never seen that. I've never seen that. Usually the trust deed, because a resolution needs to be based on the trust deed, and you can bet the trust deed will not use the words personal service income anyway. So what would that mean? Yeah, that's a tricky one to think about it.
Director fees, maybe?
Hmm?
Yeah, super issues with the director fees.
Yeah, that's another way, but then still that should be super, because it's still going to be ordinary time earnings. So that's always the problem. It's better if you can get it out to the right person as a dividend or a trust distribution. Tax office doesn't really care how it gets there, as long as it gets there. And you just don't want to add imposts along the way, like super,
Just
payroll
change
tax
trust
and all that kind of stuff.
Change the trust resolution. Post the
I'm not going to say anything, Debbie. All right, so that's PSI. And so most of what I wanted to focus on was that classification of the income. That's the important thing. Classifying the income before you then have to get down into the nitty gritty of, is it a PSB, is it not, what's attributed, what's not, who pays tax on it, when do they pay tax on it. If you can take it out at the top, then you don't have to worry about the rest of the flow chart. So that's important. I mentioned at the front end that we had those 4 types of income. And income from a business structure is not PSI, and that means you can alienate it. Up until September 14, that's what we're all doing. So any business could alienate its income, whether it was running a business of building, skyscrapers, or running a deli or an accounting firm. If it's business income, it can be alienated. September 14, sort of out of the blue, the tax office issued some guidelines. So not a ruling, not a practice statement, not a law a companion guideline or anything else that they make up these days, just some guidelines. So just something helpful that we might want to read. And they said, we're concerned that professional service firms, so businesses, not personal services businesses, but actual businesses providing personal services, we're concerned about alienation. And we're concerned that the principals are not being adequately remunerated. And they didn't mean that in a good way, that people who ran these businesses weren't getting paid enough. What they meant was the principals weren't returning enough income in their own tax returns. They were splitting it off everywhere to kids and spouses and corporate beneficiaries and wherever else they could split it. Therefore paying less tax. My God, who would do that? So rather than go into some details of why they were concerned and what the legal basis was, because many people thought, what is the legal basis? They did something smart, which is sort of tax administration in the 21st century, which is let's not get bogged down with the technicalities. Let's just tell people we don't like something and give them an option. So they gave you an option. If you were worried and you ran a professional services firm, accountants, lawyers, architects, engineers, medicos, any professional services, then as long as you do one of these three things with your income, you're low risk and we won't come knocking on your door. And obviously those who are conservative and don't want the tax office knocking on their door, they can just do that and not worry about it. So one of three safe harbours. The first one was that the principal is remunerated at the same level as the highest band of comparable employees. So that's kind of difficult to really get an example of outside of a law firm. So a law firm will generally have senior counsel. Senior counsel are usually very senior lawyers who may or may not have been principals in the past. So very experienced, probably have the same charge rate as one of the principals. If they get paid $300,000 a year, then regardless of what the principal makes, so let's say the principal's earns $700,000 a year out of the practice, as long as they return $300,000 in their own tax return, whether it's by wage or distribution, the comparable amount that the senior counsel gets paid, then they can alienate the 400. Do what you want. Most professional services firms find it hard to find a comparable employee to the principal, because generally they get to that point and they become a principal. So you don't usually have the employees. So the second one is probably the more common that I've seen used as a safe harbour. 50% of the principal's income is assessed to them. So in the example before, the law firm, that partner is entitled to $700,000 from the practice. As long as $350,000 is in the partner's personal tax return, whether that's by way of salary, partner distributions, dividends, trust distributions, however it gets there doesn't matter. As long as $350 is in their tax return, the other $350 they can alienate, split with family members, corporate beneficiaries, whatever they want. Or number three, the principal and their associated entities. So all of the entities that get the 700 grand all have an effective tax rate of at least 30%. Now I'd assume that would now be 27.5, but they haven't updated those guidelines since September 14, so they haven't specifically said it. So what that means is, provided that $700,000 goes to entities, family members, individuals that all have an effective tax rate of at least 30%, fine. The silly thing about that one is if you distributed $416 to a child, you would fail, because the child would have zero tax at $416, and therefore the other $699,000 that you sent around everywhere else and paid more than 30% tax on wouldn't be satisfied. Now, that's just a guideline, it's not the law. I doubt the tax laws would be that harsh on it. So what did they say? They said, there's the guidelines. So stick in the safe harbour, we won't come and bother you. Everyone else, we're going to come around and have a look. So they said in 2017 they're going to come around and have a look. And perhaps an advantage of living on the West Coast is that I didn't hear anything. So there's 200 odd accounting firms and law firms that I deal with regularly, and spoke to many of them about this in terms of how they ran their practices. Didn't hear a word. Didn't hear a word from anybody. So there was always some sort of doubt about, well, should we comply with this? What are they doing? Did they just send this out and go away? Or what did they do? And about 2 weeks before Christmas just gone, December 17, all the toys come out of the cot and the tax office suspended the guidelines. They said, we're not happy. We've been reviewing some firms, clearly not around here, we've been reviewing some firms and we believe that they're misinterpreting the guidelines. Interestingly enough, the misinterpretations that they said seem to have nothing to do with the guidelines. They were about creating artificial structures and things that weren't even mentioned in the guidelines. So obviously, someone had a cup of tea and a bit of a lie down over Christmas, and after Christmas, they said, okay, well, if you're complying with the guidelines, they still apply up to June 18. But we're going to go and revise them for these people who have misinterpreted things, and we're going to issue some new ones by the 30th of August. We haven't got it. So if you can find your way through, and it's a pretty tricky link to find, there is a part of the tax office website that deals with sort of contentious issues, under consideration. August 18 was changed about 3 weeks ago to December 18. So in December 18, we'll be getting some updated guidelines, maybe, on how they intend to deal with the income earned by professional service firms. What should you do about this? Well, certainly if you've got clients that are operating professional service firms, so more employees than principals, they need to be aware of these guidelines. As I say, some firms that I spoke to, less than half, were happy to comply, didn't want any trouble. Others, typically law firms, would say, what's the technical merit? And I would say, I don't think there is any. And they would say, well, bugger it, we'll just keep doing what we're doing. So as long as they're aware, they can make their own call. So if you haven't made them aware, wait till December 18 and we'll see what comes out. So it's still on the way. So say professional services does generate a number of tax questions. Contractor employee is one of them. PSI is another very, very important one. What I wanted to go through today, as I said, was really that classification of the income. So determining whether it is PSI or whether it can be, even part of it, can be something else. Can it be income from the sale of goods, the use of an asset, or income from a business structure? It's an annual determination. And in some respects, it's an invoice by invoice determination.
Sure, just on that. If you're a PSB for the first 3 months, you lose the contract and you go back to being PSI. How does that work?
You would then separate that income.
So you'd have 1 quarter and then 3 quarters.
Yep. So if you attributed PSI, clearly all of that would have to go down.
Yep.
If you're a PSB, then there might be some deductions you could claim in that period that you couldn't claim in the latter period. A little complicated, but that's technically how it works.
It's not an aggregation of the whole.
No, it isn't. And that's an important thing. And really just to finish before the urn blows up or we have some lunch, just a couple of points which sort of takes on the point that Russell just made there. We've got a situation here, a lawyer practices on her own to start with. Does it through a company's owned by a trust, provides general legal services, also prepares deeds and agreements and other documents as part of those services. The company employs a part-time admin assistant, happens to be her son, who's going through uni. And he actually works in the business performing administrative tasks. Halfway through the year, the practice then employs a graduate lawyer who then assists the principal in providing legal services, generating fees. So she comes to you after the end of the year with all her stuff, wants you to do a tax for the company. So first question, not employee, it's an entity, don't have to worry about that. First question is that company deriving PSI? It's not that easy. because there are different types of income. So the first half, lawyer practicing on her own. Got an employee, but an admin assistant. For the second half, now got a grad. Now arguably, we've all been grads, arguably they're not doing much. But the rule of thumb says 1-on-1. She's a lawyer, she'll have a crack at that, you tell her what the risks are, but the rule of thumb says, well, that's a business. So you would have at least 2 halves there. Is there anything else in that first half of the year that might not be PSI? What do you buy online these days?
You can probably the deeds and all that.
Yeah.
Written
Maybe.
Maybe she's outsourcing or.
Maybe some of the trust deeds, she just, someone says, I need a trust deed. Is that personal services income? I don't want to give away any secrets here, but lawyers don't actually write them. Someone did at some point, but they buy them. They buy precedents. They might add a little bit here and there, and then they just resell that precedent. Exactly. Maybe there's an argument there. Now, if it's incidental to what she does, so if she's assisting a business, working with a business in selling the business and prepares the sale agreement, that's, I think, part of that service. But a trust deed, or a deed of forgiveness or any of those other Div 7A, a loan agreement deed, those things that you just tap on the computer and buy for whatever, maybe that's not PSI. Maybe that's the sale of goods. So we might be able to, in that first 6 months, actually take out a bit that relates to that. Now, it depends what her records are and how she's allocated that. I would assume you could do that. So that PSI, we may have just, shrunk a little bit. We've got income from a business structure from the second half, if you want to take a rule of thumb. Got some money from the deeds and the markup she makes on that. And then we've got some PSI. So what happens with the wages that she pays to her son? Could she deduct them for the whole year?
Unlikely.
The PSB and the first.
Or she'd be a PSB? Clearly she's seen more than one client. So, yes, she could. Doesn't really matter whether it's a business or a PSB. She can get a deduction for her son providing admin services. If it was attributed PSI, no, couldn't get a deduction for that first bit that was attributed, but then could when it was a business. So it could be quite complicated. This quote's going up all the time for this lady's tax return. But we're providing some benefits. We're getting a bit of tax planning for it. I think that was about it. What else was in there? Okay. She doesn't pay all of the money out. Doesn't need all the money or knows the benefit of a company, needs some retained earnings, pays the 27.5% tax, pays some dividends out. The dividends go to the trust. What can she do with those dividends?
So she gets more than $80,000 distribution.
Why 80?
Well, because
Are you playing with it?
the guidelines.
The guidelines.
Aren't we applying the guidelines?
You could do. That's another one. Well, it would be quite complicated because the guidelines apply to the second half of the year. It's a PSB for the first half of the year. So for the second half of the year, she should be able to alienate subject to the guidelines. For the first half of the year, it's a PSB she can't alienate. Let's not pay a dividend this first year. Now that you've got an employee, we'll worry about dividends next. But that's just overly complicated, really, isn't it? But that's, you've got to classify each type of income and then determine, well, the dividends just came from the income from the second half of the year. The income from the first half of the year, I've paid to myself. But from the second half of the year, I've alienated some of it, but I've made sure I've kept within the guidelines. So what would be a relatively simple sole practitioner with a graduate can actually raise a number of questions in terms of PSI, PSP, that kind of stuff. I think that'll do us.